He's Tom Lee, the chief U.S. equity strategist at JPMorgan. Expects the economy to rebound higher versus the street expectations. You recently raised your forecast, right?
Yeah, that's right.
John, of course, and Dominic joining us as well. What does this housing data, though, tell you?
It's definitely disappointing, but it does seem like something is not linking between Shiller's data and what the home builders are saying. We had a home builder conference last week, and the message coming from the builders is pricing is stable. And you're seeing it in the new home numbers and in their reported results. So
You mean they see demand? Demand is coming back?
Well, they're seeing price points stable, meaning what they're selling, they're not discounting. They're not double dipping. They're not at new 12-year lows for prices, for entry prices. And so it does seem to me that Shiller's data is distorted by short sales or some other statistic there.
Well, remember, that's a huge point here, because when it comes to home builders, they produce new homes. And the conventional wisdom has been, if you have so many homes supplied out there because of foreclosure-related items, short sale-related items, if they're starting to feel better, that's a good sign. But all signs right now say that, even though sentiment might be improving, it's still languishing, Tom, at near record low levels.
That's right.
Now.
I think with housing, though, we really have to judge it by household formation. In other words, I'm not going to look at prices. I'm going to look at, okay, well, the economy's adding jobs. We know that we're going to add close to 2.5 million jobs this year. And we know banks are beginning to ease credit. We're really seeing that in some of the lending standards. And so that is really what I think is going to propel a housing recovery, because what you have now is a household formation engine here underway, and then the ability to access credit. I think the Shiller data, again, and some of these home price series, they're not really being consistent. Loan performance is showing stability in non-distressed sales.
I think we should point out one of the biggest challenges for the banks. You're right, Tom, that they have been more willing to lend, but they're not finding enough people with the credit profile, give them the stamp of approval to lend to. In other words, they are willing to lend, Betty, but there aren't enough people out there that fit the profile to get a mortgage, and that's where you've got the supply-demand problem, and why you've got people who say home prices could continue to take a bit of a hit.
Yeah, again, I think a lot of the improvements happen on the margin. Consumer credit standards eased last year about 6 months before we saw consumer credit begin to expand. So I think what we have to be cognizant of is really 2011 is the first time banks are actually easing really on mortgage availability. I think there's going to be some sort of lag, but I wouldn't be surprised to see mortgage demand actually pick up in the second half.
Is there a possibility that the reason why what you're hearing from builders and what we're seeing in Case-Shiller is not connecting because, maybe there's different geographic areas that are improving more than others? Maybe when you're talking about household formation, that's going to filter more into the rental market versus actual housing sales, that type of thing?
Yeah, and I think that's certainly going to be the case. I think we're going to see a skew towards rental in household formation, but, you have to keep in mind rental vacancies are at 6-year lows. There's fewer places to rent today than there was in 2004. So you've caused huge tightness in the rental market. In some cities, rents are up 20%. So, it becomes a very uneconomic decision for a household formation to actually rent versus buy.
Well, how about this, though? Let's circle back to the two major concerns on many Americans' minds right now. Housing, one of them. Number two is employment right now. According to the National Association of Home Builders, each new home that gets created creates 3 full-time jobs for Americans out there, as well as tens of thousands in tax revenues at the federal, state, and local level here. So what happens here? If we can get housing started again, does that start to improve the employment picture, or can the employment picture proceed without a housing recovery?
It's a little chicken egg. It's actually both. And it's a point we've been making for some time. Every 250,000 starts is about 1 million jobs created. If you look at from peak to now, the economy's lost 7 million jobs. So we've recovered about 1.5 million from the low. 4.3 million of those jobs lost are directly tied to residential construction. So 60% of the jobs that we haven't recovered yet are tied to housing. And remember, if we can get housing starts to 1 million, that's going to be more than 1 million jobs created.
We are back with JPMorgan's chief U.S. equity strategist, Tom Lee, who believes that the U.S. economic data, barring housing, is actually bodes well for a higher market or equity market.
Yeah.
What do you make of what Mobius just said?
I think big isn't necessarily the risk. I think the financial crisis was built on false assumptions about ever increasing home prices and, a false belief that home prices never fell, and then the employment of excess leverage. I
I think it's leverage. Leverage is the problem.
Yes, but again, I think that the difference today is I don't think people are making. Yeah, I think people are examining every assumption. So, I mean, I think the fact that simply banks are bigger today or there's still derivatives, I don't think that's the reason we'll have a financial crisis. We'll have a financial crisis because of complacency and then the assumption that you could take greater risk on a false assumption.
But, I mean, you work at a big bank. Do you feel like derivatives are being used even more so today than they were during the financial crisis?
I think the exact opposite's true. If you, one measure to really judge this is look at banks' VAR, value at risk. I think in almost every case, the dollar value of VAR is lower than it was 5 years ago.
How much risk they're taking every day.
Correct. Whereas their existing equity capital is probably double where it was 5 years ago. So I think the sheer size is not the issue.
However, there's a correlation to that because banks have not done well.
Well, they haven't done well, but they're doing a lot better. And I think the reality is that large institutions are going to be very careful about taking risk and how they use capital. So I think there's a lot less risk of it today than there was 3 years ago.
Well, Tom, speaking of taking risk here, your firm just upgrades Goldman Sachs, one of your peers out there, to outperform on this idea that they can leverage more out of their existing operations. That includes taking more risks, right? That means getting more involved in the markets and really pushing things forward. So how does that kind of jive with how the economy is going to go if these banks don't take as much risk as they used to?
Well, again, I think banks right now are operating with they do need some clarity on ground rules, right? Because there's capital buffers that need to be established, and just a more stable regulatory landscape. I think once that's established, I think banks will have a better feel for how much excess capital they have, and then you can see banks start to target other areas of costs like compensation ratios, et cetera, and some of these things that were brought up in that upgrade.
Tom, talking about risk, why aren't investors taking on more risk?
Well, I think investors are still very cautious. They're still living as if this is a crisis. And I can understand. I mean, if you look at the small business optimism surveys, the average reading tells us we're still in a recession.
Okay, but perhaps one that takes on more momentum in the second half of the year is what you're saying.
That's right. I think, so we've always been sort of thinking the middle months would be kind of flattish, and then we'd see a very big rally in the fall.
Do you think this Euro situation or Europe situation is one reason why, as we talked about earlier, that you're not seeing more investors take on equity risk?
Absolutely. I mean, I think when you sort of look at reasons to sort of not be involved with equities, you've got Europe, you've got the Middle East, you've got the Japan quake, you've got QE2 ending, and then you've got Washington and the debt ceiling. I think in recent weeks, the thing that's been on top of mind for investors has been Greece and peripheral Europe in general. And
yet, have you been surprised to the extent that it hasn't affected, though, the markets here as much as you might think it would?
Well, I think what we've seen markets unwind leverage, excess leverage. So we can see it in the hedge fund leverage and the beta data that we can see. And where it was the most severe was in commodities. So I think we've seen a commodity correction, which really reflects the unwind of leverage. And I think equities had a much milder correction. And it really speaks to the fact that people just weren't taking a lot of risk heading into this crisis, actually.
But does that then signal to you that perhaps we're not pricing in enough of the risk of Europe in equities?
Or I think that what it just tells us that any kind of correction one would expect will be a lot more severe in commodities than it would be in equities. But conversely, I think this is going to send a pretty good signal. I mean, this was resolved without this spiraling into a major bank crisis.
So far.
So far, that's right. And I think, the fact that European equities have actually performed pretty well gives us a pretty good signal for the U.S. as well.
You see more buying going towards the end of the year. Why is that?
Well, as we get into towards the end of the year, I think we're going to see the real benefit of the employment market adding to labor income and therefore adding to economic growth. And we also see housing really starting to improve at that point. I think vacancies. And so that was giving us a lot more optimism about 2012 EPS. So we raised it to 105.
Okay.
And then if you put a 14 multiple, that gets you to 14.75.
So macro factors then.
Correct.
Factoring into that.
Come back to something that Tom said. Here in the U.S., here in the U.S. If you look at the ISM Manufacturing Index, I say this because David Kostin of Goldman Sachs, he does what Tom does at Goldman Sachs, he came on Inside Track this morning and he said, look at the trend. The numbers have been falling since February, and we're going to get another reading tomorrow. It's expected to be down again. That says to him that profit margins will eventually start to get hit. That's going to hurt earnings next year. That's one of the reasons why he recently took down his estimates for where the S&P is going to end the year. How do you feel about that argument?
Well, you know, I mean, it's sort of, there's a couple of sort of things to think about. One, you know, we're having a very old-fashioned inventory adjustment, right? You know, final sales in Q1 wasn't as strong as people expected, so the downturn in ISMs is really just a small minor inventory adjustment. In terms of profit margins, I think it's too early to call a peak in profit margins. I mean, only 2 out of the 10 sectors in the S&P are past their prior peak in margins. So, you know, do we really think 8 out of 10 sectors have no ability to either have operating leverage from top-line growth, cut further costs? I think there's going to be a lot of room for profits to expand.